Most people experience the economy in very simple ways. Through prices at the supermarket, through rent, through fuel, through how easy or difficult it feels to plan ahead. What most people never see is that those changes usually start somewhere else, long before they arrive in daily life. They start in places like government debt markets, central bank language, trade expectations, and the way investors quietly adjust their behavior when uncertainty rises. That quiet adjustment is what we are seeing now. According to reporting by Reuters, during January 2026, global financial markets began reacting not to a single decision or a single event, but to a combination of pressures that started reinforcing each other. Geopolitical tension, renewed trade uncertainty, and concern about financial stability began to show up not in headlines, but in prices. This matters because markets do not move when something happens. They move when the cost of uncertainty changes. One of the first places where this shift becomes visible is in government. Bond markets. In mid-January 2026, yields on sovereign debt began to rise across major economies, including the United States, parts of Europe, and Japan. This movement did not follow a coordinated increase in policy rates by central banks. That detail is important because it tells us this was not a planned tightening. It was a defensive response by investors. In technical terms, investors were demanding a higher risk premium. In simple terms, lending money started to feel less predictable than before. When someone buys a government bond, they are lending money for many years. They are trusting that institutions will function, that trade will continue, that political decisions will not suddenly disrupt the system that supports repayment. When yields rise without central banks pushing them up, it usually means that trust is being reevaluated. This does not mean investors expect governments to fail. It means the future feels harder to ensure. Reuters reported increased sensitivity in global debt markets, including volatility in Japan's government bond market, following adjustments to yield expectations earlier in 2026. Japan is often seen as a reference point for stability in sovereign debt. Its market has long been associated with predictability and strong institutional support. When volatility appears there, it signals that pressure is not coming from within one country, but from the global environment itself. In other words, even systems designed to absorb stress are responding to external uncertainty. At the same time, the language used by central banks began to shift. In January 2026, officials from institutions such as the Bank of England publicly acknowledged rising financial stability risks linked to geopolitical and trade tensions. Central banks are careful with communication. They do not exaggerate, and they rarely point to political factors unless those factors are already influencing financial conditions. When central banks start emphasizing stability rather than growth or inflation, it signals concern about fragility. Not collapse, but fragility. The kind of fragility where shocks can travel faster and hit harder than before. For most people, that sounds abstract, but the translation is very simple. When central banks worry about stability, banks become more cautious. When banks become more cautious, credit becomes more selective. When credit tightens, businesses slow hiring. Households face higher borrowing costs, and financial flexibility shrinks. That is how a macro signal turns into a micro experience. Trade expectations are another part of this adjustment. Over recent weeks, political rhetoric around tariffs, strategic trade, and supply chain security has intensified. Not all of this has turned into formal policy, but markets do not wait for laws to be signed. They price expectations. Reuters noted that investors and companies were increasingly factoring in the risk of renewed trade friction, even without immediate implementation. Modern supply chains were built for efficiency, not resilience. They depend on smooth borders, predictable rules, and low friction. When companies expect disruption, they change behavior. They diversify suppliers, shorten supply chains, increase inventory, and accept higher costs in exchange for lower risk. Those costs do not disappear. They move through the system. They compress margins, raise prices, or limit wage growth. That is how trade uncertainty reaches households without ever appearing as a headline. Energy markets quietly confirm this broader signal. During this period, oil prices remained firm rather than collapsing. That suggests markets are not pricing a sudden global recession. Instead, they are pricing persistent geopolitical risk combined with constrained supply. In simple terms, energy is expensive enough to create pressure, but not cheap enough to relieve it. This creates an uncomfortable balance. Higher energy costs raise transportation and production expenses. Combined with rising financing costs, this squeezes both businesses and consumers at the same time. Now add debt to this picture. Global debt levels are historically high across governments, companies and households. This debt expanded during years of low interest rates and abundant liquidity. High debt is not automatically dangerous. It becomes dangerous when conditions change. Most debt is not paid off. It is refinanced. That means the system depends on open markets and investor confidence. When risk premiums rise, refinancing becomes more expensive. Governments lose fiscal space. Companies delay investment. Households feel pressure through higher loan payments. The simplest way to understand this is to imagine carrying weight. Debt is manageable when conditions are stable. When the environment becomes uncertain, the same weight becomes heavier. That is what is happening now. The environment is changing. The effects do not arrive all at once. They accumulate. Credit becomes slightly tighter. Hiring slows slightly. Prices edge higher. Planning becomes harder. None of this looks dramatic on its own, but together it changes the rhythm of the economy. Not all sectors are affected equally. Periods of uncertainty often benefit energy producers, defense and security industries, commodity suppliers, and companies focused on essential services. Businesses with strong balance sheets and low debt gain relative advantage because they can operate while others slow down. This is how capital reallocates during structural transitions. What we are witnessing is not a temporary reaction to news. It is a recalibration of how risk is priced. Markets are adjusting to a world where trade is less frictionless. Geopolitics plays a larger role in economics. Money is no longer cheap by default, and stability carries a cost. This does not mean collapse. It means the system becomes more sensitive. Small shocks matter more. Delays matter more. Policy mistakes matter more. The signal, translated simply, is this: the global financial system is under pressure because investors are treating political risk, trade uncertainty, and high debt as long-term structural costs rather than temporary disruptions. Once a system makes that adjustment, behavior changes. Even if tensions ease, trust does not fully reset. Markets move before policy. Costs rise before headlines. Systems adjust quietly. If you understand how those adjustments work, you do not need to chase the news to understand where the world is heading. That is the purpose of Money Signal.